And joining me on the panel tonight, we have Ben Clark from TMS Capital and also Russell Muldoon from the Montgomery Fund. I mean, looking at your portfolio and how you're positioning the portfolio at the moment.
So look, we're exactly like Magellan. We've been net sellers into this market. We're actually holding about 30% cash in the private fund and about a quarter of the fund in cash in the retail fund, the Montgomery Fund. There's a simple reason for that, and yeah, we just said it before, the markets are generally pretty expensive. Look, if we strip out mining and engineering on a forward earnings basis, we're trading on about 18.7 times forward earnings. And look, the market hasn't been here since just pre-GFC. But what we had pre-GFC is we actually had companies which are growing 10, 15, 20%. At the moment, what's growth in the market? You know, we're probably 0 to 5. So look, we've got a very abnormal situation where we've got companies trading on multiples we haven't seen for a long, long time, and the economy is so weak, and it's why interest rates are where they are. It's a fundamental disconnect between earnings and share prices at the moment. We did a little bit of analysis since February 2010 to February 2015. We looked at the market growth. Market is up about 26% in terms of capital growth. And then we stripped out what is PE expansion, so what is just price going up versus what contributes to that from an earnings growth perspective. And what we found was 80% of the market over that period is just pure multiple expansion, so people willing to pay more for a business, whereas about 20% is just earnings growth. So
wow, that's interesting.
4 or 5% earnings growth over the last 5 years. It's been a pretty anemic period, but a great, obviously, run in the share market as interest rates continue to fall.
Sounds like it's going to be a very interesting show, and we do have our first caller on the line, so let's go straight to Mick from Sydney. Mick, welcome to the show. What's your question tonight?
Good evening, Julia and panel. My question is about a stock code NRC company called Novagen.
Sure.
They were suspended this morning with an announcement to come through on Thursday. Obviously, the announcement came through a few hours later after I opened today, and it just dropped significantly. I just want to know if you or the panel know anything about it.
Sure. I mean, a really good question coming through from Mick. We've seen Novagen running very hard. This is an anti-cancer drug company, and the shares have been doing very well so far in 2015, from around about 10 cents to an all-time record high of actually just a yearly high of 45 cents for the company. But today, announcing a capital raising for about $30 million, and the shares tanking down 30% in value. So, Russell, what do you make of this one?
Look, just looking at the announcements, it's pretty clear that they're doing the raising, as you mentioned, Julia, and the raising is being done at 30 cents, so the share price closed at 29 cents. So it's closed around where the raising is. That's purely the reason. Look, they look like an early startup cancer therapy product developer. So, you know, they've obviously taking the strong rise in their share price as a bit of a chance to get some capital in the door, get some money in the door, and be able to fund their development program over the next few years.
Okay. Hold for the time being. How about you, Russell?
I would actually lighten this significantly here.
Oh, wow.
Look, I think roll-ups are really good when companies are small and they can buy things and small things, and they add a lot to the bottom line. They can buy them cheaply. They can buy them on 3-4 times EBITDA. When you start getting up, 6.9 was their number, and they adjusted Quindel's earnings quite significantly to get to that 6.9 number. The actual number is about 8 or 9 times EBITDA on an unadjusted basis. So that's quite a multiple to pay for such a large acquisition. And history has shown time and time again that when you're small and you're making small acquisitions cheaply, you can add a significant amount of value to shareholders. You get that PE arbitrage, the PB multiple arbitrage. But when you start making big acquisitions and take big chunks, you got to think, business is already big. It's made a lot of acquisitions in the past, and it's made a huge acquisition now. So the business effectively has doubled overnight. And that's hard for management to manage. You think from an acquisition, they've bought earnings, fine, earnings go up, shareholders are happy. And I think in the presentation they said earnings could go up 30% over the next 12 to 18 months. I mean, that's a great outcome, but they've got to manage a large business, not only in Australia now, but in the UK. So the risks are elevated at the very time that they're now buying elephants. we just think, we're cautious around this, and we've seen it recently with Green Cross as well. That was a market darling. Did really well making small acquisitions, but then obviously bought Pet Barn and made huge acquisitions, and since then the share price has really, really struggled. So look, I just think the risks are heightened now around this stock, so I would be cautious.
Okay, so is it a buying opportunity, Russell?
No, I probably agree with exactly what Ben said. Cash flows always lag reported profits. I can't remember the actual accounting convention it used to be called Cigaris or something like that, where they revalue the fish every single year. They add that to the profit, but cash doesn't change because the fish is sitting in the water. It's waiting to be grown a little bit more and then harvested, then sold, then the cash comes through the door. So there's a huge lag between reported profits and cash flow, and cash flow always looks pretty average compared to like a software businesses where cash just streams through the door and they can make acquisitions and reinvest and do lovely things. It's quite a capital intensive business.
Yeah.
And like you say, pricing's not really within its power. It's salmon prices, set globally. And your whole flock, or no, not your whole, your whole salmon, harvest in 1 year could be wiped out. Shark could get into the net, go on a bit of a feeding frenzy, could get wiped out by viruses. It's not a business that we would invest in and want to hold on to.
And Challenger Financial Group, looking at that annuity type of business, you think that in this type of market would be doing well, but are they the best choices if you were looking for income? Russell, what do you think?
Well, it's interesting that new fund that you mentioned, I don't know a lot about it, but the infrastructure fund, listed infrastructure fund, that would be a pretty clear bet that they're looking for very stable assets globally. Looking to raise money obviously within this entity and then to go out and buy these for probably their yield, I would say. So that would be Argo's tilt, I would say, at an income product. So you might want to have a look at the prospectus for that and what they're actually trying to do. In terms of Challenger Financial, look, we own Challenger Financial. I'll just admit that right now. We think Challenger has very bright prospects. It's really the major player in the annuity space within Australia. So it's currently in the 4th year of a 20-year structural tailwind where we're seeing the richest generation in history being baby boomers and the wealthiest generation in Australia's history being baby boomers, now moving from the accumulation phase into the decumulation phase. They're looking to protect their capital and for a stable income, which is exactly what you just mentioned that your mum needs at the moment. So they offer an annuity product. Now, in Australia, about 60 billion in retirement funds heading into the retirement phase at the moment, the decumulation phase. That's forecast to grow from that figure, 60 billion, to 200 billion over the next 10 years. That's a factor of 4 increase. Now, annuities only make up about 4% of that market at the moment. And if it follows other decumulation markets around the world, that's going to grow to 10. So that's another 3-fold increase. So the market for Challenger, and they have about 80% market share at the moment. Sure, more competition is going to come in. But that's a huge market expansion opportunity for this business. And very few businesses on the ASX have that opportunity in front of them. So look, we think that's a good business. But the Challenger is not without its risks. It is an equity market product. And if your mum is after a stable income, then look, shares probably don't give you the capital protection safety net. So you might want to look at annuity products for income. You may want to look at fixed interest funds, for example, like Capstream Wholesale. I'm not affiliated with them at all, but I have some of those in my own super fund for fixed interest.
Okay. Now, we were talking about G8 Education. I mean, this is a stock that was a darling of the market, and it's just come down so much from a peak of about $5.50 in September to $3.33 today. Russell, what do you think of this one?
Picking on me tonight, aren't you?
I'm going to pick on you with every question.
We're early shareholders in G8 Education, and going back to what we saw about roll-ups and acquisitions, this was a business that has grown significantly by doing what ABC Learning did in the early 2000s and buying childcare centres on 3-4 times EBIT multiples, rolling up a significantly fragmented industry and really getting that multiple PE arbitrage on the market. But a lot's changed in the last 12 to 18 months. You've seen a lot of competitors come down the pipe. The Sterling tried to get away, and they had a lot of centres on their books that couldn't get away, so G8 Education went in and bought them out. You're seeing Think come into the market. You're seeing Affinity come into the market. Now, when you get a lot of players coming into the market, of course, that pushes up the multiples, and then you don't get the value accretion anymore. So we're going to see growth slow in this sector. There's a bit of regulation risk creeping in as well. People that look after kids, they're going to have to increase the number of the ratio of carers to kids. That's going to increase the costs for G8 education. They're looking at a number of ways to reduce funding or reduce the growth in funding for the industry because it's ballooning out of control. So there's a lot of risks for this business. We're not there. We haven't been there for 12 to 18 months now. So.
Okay, so
look, PEs tell you very little about our company valuation. I mean, comparing something like a Bellamy's that sells more products to Domino's and Xero on a relative valuation sense, I wouldn't advise doing that. It's expensive or potentially expensive to other things that are expensive is not a relevant valuation metric to apply in the stock market. Agree with Julia though, if it's on 150 times PE, it's growing NPAT 140%, it's going to come down very quickly. That PE ratio is going to halve this year. If it grows at 100%, if it grows at another 100% next year, it'll come down to 35. So look, it'll come down very, very quickly. And if it grows in excess of that rate, obviously that PE multiple will come down a lot quicker. So that's what the market's doing. It's moving ahead of projected earnings growth. Just having a look at the half year though, look, this business is obviously quite working capital intensive. So obviously develop the milk products, hold it on its balance sheet, its inventory until it's sold.
Yep.
So it's got huge negative operating cash flow outflow in the first half. So it means probably there's a lot of inventory sitting on the balance sheet waiting to be sold. I'd want to make sure that those cash flows are going to come back through the business, or it could become capital raising. I mean, growing very strongly in a market where it's not really growing. It's getting bid up. So it looks okay.
Too pricey, Russell?
Look, I'd want to see the Morgan's research report how they came up with a price target of 385 to see what growth they've got in earnings to get there. Look, I'd probably reserve judgment until I did a bit more work on the business. It's growing very, very strongly. That's obviously very attractive. Having two kids who drink a lot of milk products and a lot of milk formulas, it's obviously a very attractive market to be in. But obviously very competitive. You've got Johnson & Johnson in that space as well. You've got some global behemoths you're coming up against, and they've got bigger balance sheets than this company. I can bet on that. So.
Absolutely. So it's been a phenomenal ride for Bellamy's. Floated at $1 last year, stock hit a high of $3.50 this year, going into China, but most of its growth really coming from Australia at this point. They've got about 15% of the Australian domestic market. It is now time for a viewer email. Matt writes, I'm interested in Carsales. Is it a buy at current levels? So looking at CAR is the ASX code now. It's been moving sideways. Just recently it broke that $10 mark, so it's under $10. Would you be buying, Russell? Yeah,
you probably saw the substantial notices recently. Hyperion have been selling their holding. They're one of the largest holders, if not the largest holder. And when they decide to exit a business, it's pretty well known what they do in the market. They exit very, very quickly. Obviously, they're going to be careful of the share price on their exit, but that's why the share price is breaking down at the moment. And the market is aware that they're selling big chunks of stock. I think they've got 20 million plus shares to exit. So do you think this is an opportunity? Potentially. Look, this is a great business. It's obviously a business that has huge network effects. So it is the #1 car retailing for used cars retailing site on the internet. Because of that, it attracts the most number of advertisement, attracts the most number of eyeballs, and that's a self-reinforcing loop, which is a pretty hard barrier to break. We're seeing Cars Guide, I think, come at them 3 times now. They just got another round of funding for about $30 million, and I think they're almost through that. And we've really seen from internet statistics that they've really made zero dent in terms of their market share and market penetration. So very hard businesses to knock off. Saying that, the car market in Australia is 1 million new cars per year, about 2 million used cars per year. So there's a saturation point where you reach when we live on an island with 20 people and growth can mature. So they've been looking at international investments. They've been making huge acquisitions overseas. I think Mexico, for them, probably be the next asset that takes off, followed by South Korea. So look, they've got some growth coming, but that might be 5 to 10 years away, and in that time, they're going to use Australia, which is maturing, to fund that overseas growth. So I think it's one you have to be pretty patient with.
Okay. Which really only leaves Senex Energy and Origin in terms of unconventional gas over in the Cooper Basin. And it's a hard area to be in. Would you be buying Senex or even
look, I would put
drilling?
these completely 100%, no arguments, in the speculative basket, and I'd have very little of my capital. Now, if you wanted to have a bit of a play in this space, you can punt on a oil price rebound. I don't know when that's going to be. Sure, you can have a bit of a go. Look, they both got pretty good balance sheets. They've got both net cash in an environment where no one is likely to lend them cash or give them cash, or they'll find it very hard to raise cash. They've got a little bit of working capital there to get them through probably next 18 to 24 months, and hopefully you will get that bounce in the oil price, which we'll see them bounce as well. They've got no debt. Senex, I'm having a quick look at its balance sheet. It's got significant provisions though. It's got a lot of land it has to rehabilitate. It's got about $57 million out of 75 million cash bank balance that it has to spend on rehabilitation. So not all that cash is theirs at the end of the day. But look, they've both got net cash. They might have some good assets. I don't think you have to be a geologist to work that out and go in there and turn some rocks and maybe put a little drill in the ground and see if you can find some oil there yourself. But I don't know. They're very highly speculative investments, and you have to fully expect going into these things you may make money, you may not.
The Newcrest. I mean, would you be buying either Newcrest or Leighton's?
No. Obviously, our views on the engineering infrastructure sector and the capex cycle. No, you have to be lucky to make money in gold and gold producers. Shareholders recently been lucky. One area we like is software. There's a lot of companies in this space, Hansen, GBT, and Altium, which we actually own in the fund and own a significant position. Look, those businesses we consider to be low risk, have high growth, and in this market, actually offer some value for the growth prospects for the future.
Okay, so some great alternatives there from Russell. And on that note, that's all we have time for today. Thanks so much to our guests tonight, Ben Clark from TMS Capital and Russell Muldoon from Montgomery.